Good morning, everyone. Thank you for joining this pre-summit webinar where we'll be discussing the opportunities that are there to rebuild the country in a more sustainable and equitable manner through innovative finance. And this webinar is a precursor to two key events that will be taking place in Colombo in February. One will be the Impact Investment Executive Immersion Program, which will give you an in-depth understanding of the key concepts of impact investing or sustainable finance as it's previously known, and provide you with an internationally recognized certificate as well. The immersion program will will take place on the 9th and 10th of February at the Shangri-La in Colombo. We will share this QR code and the link for the registrations on the chat. We would like you to register and also be part of those events. And then that event will be followed by the Lanka Impact Investment Summit 2026, which will bring together key international impact investors, development partners, leading corporates and SMEs and other stakeholders for a two-day convening, also happening at the Shangri-La in Colombo, which will take place on the 10th and 11th. The links for this will also be shared on the screen and also on the chat. And we invite you to register and be part of this conversation. And during this webinar today, we aim to kickstart the conversation around two key concepts within the impact investment ecosystem. One is the gender lens investing, which provides for more equitable opportunity for everyone, and blended finance structures, which provides working financial models around the world. We will hear from international experts about these concepts and how this will work in Sri Lanka. But before we proceed further, we would like to highlight some technical tips that would be useful during the webinar. So the moderators will always keep your mic on mute. As an audience member, you need to keep your mic switched off. If you run into any technical issues, please drop a message in the chat addressed to host and panelists. And also, we invite you to post questions during the discussion using the Q&A option of Q&A option anytime. I would now like to welcome Ms. Erin Bateman, the head of Asia programs at World University Service Canada, to deliver a brief welcome note and set the context for this webinar. Over to you, Erin.
Thanks, Siva. Good morning, everyone. It's a pleasure to welcome such a distinguished group of investors, investees, and development practitioners to today's webinar. My name is Erin, and I am the head of Asia programs for WUSC, which is a Canadian development NGO focused on creating opportunities for young people, particularly young women, to thrive and belong. WUSC has worked in Sri Lanka for many decades, but this moment in particular feels like a pivotal moment in this country. We're navigating the road to a long-term economic stability, and we need to ensure that growth is not just fast, but also inclusive. Finance conversations and gender conversations can't exist in silos, and we're here today to talk about how capital can be a tool for equity, how gender lens investing and blended finance are no longer just niche concepts, but are actually the engines of a resilient Sri Lankan economy. When we talk about gender lens investing, we're looking beyond just funding women-owned businesses. We're talking about an intentional strategy, integrating gender into financial analysis, investing in companies that promote workplace equity, and supporting products and services that solve the unique challenges that women face. At the same time, we know the risks in emerging markets can be perceived as high, and that's where blended finance enters the frame, by using catalytic capital from public or philanthropic sources to de-risk private sector investment, We can unlock the millions and hopefully billions needed to bridge that credit gap for women entrepreneurs in Sri Lanka. This isn't just theory. In our project, we're seeing this shift in action. Through WUSC's Growth, Resilience, Investment and Training, or GRIT project, we're working in Sri Lanka to transform the entrepreneurial ecosystem, particularly in the north. So through this project, WUSC is working with international partners like the Criterion Institute, Susie's with us today, and local partners like LIN, GLX, URLIT, and Hatch to ensure that incubators and accelerators aren't just gender neutral, but gender responsive. We're training fund managers to move past biases and see the untapped potential in women-led growth stage enterprises. And we're engaging the Sri Lankan diaspora not just as donors, but as strategic investors and coaches. GRIT reminds us that for finance to be inclusive, we have to fix the system and not only focus on the entrepreneur. And so today's webinar is really designed to move us from from the why to the how. We'll dive into the metrics because what gets measured gets managed. We'll discuss practical lessons from the Sri Lankan financial ecosystem, and we'll explore how we can better coordinate our blended efforts to ensure that capital reaches those who need it the most. My hope is that by the end of this session, we'll move one step closer to a Sri Lanka where every woman who has a vision has the capital to build it. Thanks so much, and I look forward to a productive session.
Thank you, Ms. Bateman. Thank you for setting the context and also for setting the tone for the rest of the event. Now, I would like now to welcome Ms. Susie Pan, Vice President of Criterion Institute, to present on what is gender lens investing, how it is working in other regions, and how it would work in Sri Lanka. Ms. Pan, over to you.
Great, thank you. Good morning, everyone. I am calling in today from Silicon Valley, San Francisco Bay Area, so it's actually nighttime my time, but I'm really glad to be here. So I wanted to talk a little bit about gender lens investing and the work we've been doing with WUSC and the partners there, such as Lynn. So next slide. To give you a little bit of background on Criterion Institute, we are a global think tank founded 25 years ago that works on how do we look at using finance as a strategy to improve social change outcomes. Criterion is credited with it was founding one of the fields of gender lens investing and actually coined the term gender lens investing almost 20 years ago. We are some of the early pioneers in this field and work with global partners across all continents in our work. I've been with Criterion for the last over 3 years and lead our program and strategy. And prior to that, I was actually working as an investor. So it's really interesting to be able to combine how to work as an investor with the social change that we desire. Next slide. So I want to open a little bit differently before we jump into gender lens investing to say that this is something that our founder says all the time, that humans can execute almost anything, but imagine almost nothing. We can put people on the moon, but we don't imagine a world where gender equality is the norm. So I want to approach this conversation with an open mind. Next slide. To say that finance is a system that was made up by humans. Therefore, it can be changed. This means the rules about risk, the rules about opportunity, about expectations are all made up and we can create new rules. Next. So given that open framing, I want to talk a little bit about what is gender lens investing, what are some conceptions and misconceptions of how gender lens investing works. This is the piece where I want to get into the how and the why of how we do gender. So next slide. One of the key frames of when people think about gender lens investing is that you're investing in women. So say, how many women entrepreneurs do you have? How many women on boards do you have? How many women leadership do you have? While that is important, gender lens investing is actually about incorporating a gender analysis into a financial analysis to create better outcomes. This is about valuing gender patterns. This means how we think about informality, how we think about care work, how we think about access to finance, time poverty. These are about the gender norms in a country, the gender patterns in a country, not just about the gender identity. While gender lens investing does consist of investing in women, it is only a part of the practice. So this is about we need to not just count how many women we're investing in, but really value the gender patterns that shape decisions. Next slide. And this goes to why it is important to think beyond representation. So once you put a woman on board and women in leadership roles, while that is good, it is only impactful when they have power. And one of the frames that we have a lot at Criterion is to think about how do you analyze power, not just identity. Because if you don't have power and you put people on boards, it doesn't actually create change. So one of the ways to look at generalized investing is to understand and analyze the power dynamics in a situation. Power dynamics means who makes decisions, who controls assets, whose risk gets mitigated first, who decides on structures. So you need to change power dynamics in order to change outcomes. And there are many ways to do that. I will go through a little bit some of them later, but just to understand that gender is not just about the identity, but about the underlying power structures. Next slide. And to change power outcomes and gender equality outcome doesn't come from just naming intent to say, I wish I could create gender equality. I wish I could give more women access to finance. I wish I had more entrepreneurs. Naming outcomes also doesn't always change outcomes. It's about how you change your practice. I think it was Einstein who said that if you do the same thing over and over again and expect a different outcome, that's insanity. So if you are practicing finance just as is, but you expect it to be different without changing anything that you're doing, we'll often call this about point money a woman, it doesn't actually work. You need to be able to think about how you're distributing assets, who you're talking to, how are they coming across the opportunities, what structural barriers are in place. It's as much about how the money moves as much as it is about how much money moves. So while moving money to women and to entrepreneurs, to leaders is important, it's not unless we put the structures around how the money moves to make sure it is actually beneficial. So really want to think about the structures of the way the money flows, not just the fact that money flows in itself. So next slide. And in order for money to flow, gender equality and gender equity has a future. One of the biggest, we have this paper where we compared climate finance and gender finance. And one of the biggest change for climate finance to not become a social problem is that it created a future you could invest in. You can invest in renewable energy. You can invest in the reduction of carbon. And so a similar methodology applies to gender. If you think about gender equality as an opportunity, not as a screen that decreases the size, but actually as a magnifying glass or a bigger pie to look at what are the untapped potential and untapped opportunities where gender patterns are holding back investments. This also means that in the future, gender equality actually has an investment thesis. There are opportunities you can invest in today that creates gender equity in the future. So very importantly to think about gender not only as a social issue, but as an investment thesis. Next slide. In expanding access to investment, one of the key phrases we say here at Criterion is, how do we think about fixing the capital, not the company? So very often, investors start with the type of capital they have. So I'm glad we'll have a conversation about blended finance that will give you more ways to think about different types of capital. But let's say you have a venture fund. Then your job is to look at companies that can take your venture funding. But you start with a type of capital. And then once you start looking at types of companies, you'll realize there's not enough pipeline. So when there's not enough pipeline, you spend all these money trying to do TA, technical assistance, or incubator program to get people to be investment ready, which is additional money for them to be able to take your capital. The other way to look at it is to think about which are the entrepreneurs that we're serving and what type of capital do they need. So instead of fixing the entrepreneurs or fixing the company to take your capital, design the capital to meet the entrepreneur's needs. This is actually a way to save a lot of money, especially on technical assistance and investment readiness, to be able to center the entrepreneurs and their needs and their type of capital first. Next slide. And then one of the pieces that we hear a lot about generalized investing is that we get asked a lot, what are the 4 things I have to do to become a generalized investor? And while we can give you a set of checkboxes, as in, making sure you have representation on your leadership, making sure you have ethical supply chains, making sure you're serving products that benefit women, etc. It's not about having a set of checkboxes. It's about choices because context matters. So we're going to be talking a lot about different Sri Lankan contexts, but even in Sri Lanka, how you approach gender in Jaffna is very different than how you approach it in Colombo. So really understanding the set of contexts you have to figure out what decisions you have to make matters over a set of standards. Because how you implement gender lens investing is not a universal choice. And this is one of the pieces we can talk more about that there is more understanding in investors that there's not one set of actions or one set of practices that make you a gender lens investor. It looks different in different contexts. Next. So the three main ways to think about how to frame gender, not as a social issue, but as an investment issue, I'll showcase here, but really thinking about it in terms of an investor, how you can look at gender. Next slide. The first framing is as a magnifying glass, which means you're looking at opportunities. So investment generally looks at upside and downside. This is the upside argument. This is looking at what are the underserved markets, what are the new products and services you can create, is the untapped labor innovation. This is where you look at what are the opportunities you can invest in when you understand gender patterns and gender analysis. Next slide. The other way to look at, and this is something that's actually quite common these days, is to look at the risk-oriented framing. As investors and humans, we are more careful about loss aversion. We want to protect our money, sometimes over the fact that we have to get returns. And this is where the risk framing is really important. Gender dynamics affects risk factors. How you see your operational risk, how you see political risk, how you see trade risk, how you see supply chain risk, all are affected by your understanding of gender dynamics. And what this allows you to do is gender analysis leads to better resilience when you better understand the risk and mitigate the risk. So it leads to more beta, not just alpha. And this is a framing where you can look at how do you frame gender patterns in investor language about minimizing their risk. And lastly, next slide, is an impact-oriented framing. So this is the typical impact investor to say, you don't always have to look at gender equality as outcome, but if you look at education as outcome or jobs as an outcome, there is a gender aspect to a lot of impact in intersectional approaches. And I also name here as access. So a lot of time people look at access as the ultimate impact. If we expand access to credit for women, is that the ultimate impact? And I put an asterisk there because while access is important, it is important to understand access to what. And is that the right thing for the woman that you're trying to serve or for the impact you're trying to create? So the way we always say, the example we use is microfinancing. While microfinance is useful, what Access also did is put a lot more women in debt. So really thinking about what is the right type of instrument, the right type of capital that's actually needed, and how do we improve access? And next slide. So I've framed a little bit of this in the beginning around how do you actually shift power dynamics in investment. And I'll say that we do have a multi-day training on this and multiple different ways that you can learn a deeper analysis of how to use finance to create social change. I will briefly touch on it here, but we will share the link of resources around if you want to get a deeper dive on what we call the toolkit 5 strategies. So the first strategy is who you invest in, so investing opportunities, which entrepreneurs are investing, which sectors are you investing, what stage you invest in, and how do you channel opportunities to women founders, women products, sectors that have gender dynamics like hair economy. So that's the first strategy, is basically how you think about moving capital. The second strategy is called assigning value in a market. And this is to say finance decides what is important and what is worth money. And this is where you can influence the data you use to assess the risk and the reward, as we talked about. But this is also where you think about how to make sure gender issues are material in your investment analysis. The third piece is around facilitated movement of capital, and this is actually where all the structures and terms that you use and how they play out in power dynamics and how they play out in who has access, whose risk gets mitigated, who gets returns first. The fourth one is around how you manage your business of investing, who you hire, how you evaluate expertise on your team, how you think about revenue. And the last one is about portfolio construction. So how you set benchmarks for your portfolio. These are the ways, and as I said, we have a deeper a 2-hour workshop around learning about these tools in depth, around how you can use finance to actually create the gender equality outcomes you seek. Next slide. And maybe to wrap up a little bit, so part of the conversation is what does this look like in Sri Lanka? So we have a few different knowledge products that we produce my colleague and I visited Sri Lanka last year or 2 years ago to look at what are all the opportunities that are ripe for disruption in Sri Lanka. The two that I will touch base on, and I will send you more information, is around who can be intermediaries. As Sri Lanka is thinking about rebuilding capital, the person who gets to distribute money holds a lot of power. And actually having projects like LIIS and Grit in Sri Lanka and LIIN gives different people access to capital allocation. The other one I think is actually around rural women and food security. I think there's most of the tea production, and having been able to be in Sri Lanka, the tea production is such a huge industry around and has so much gender patterns. So how do we look at opportunities in these sectors by valuing the role of rural women? And then maybe just lastly around childcare and infrastructure as sectors that have lots of potential for gender lens investing. So I know I'm out of time, so I'll just wrap it up there. And then next slide to say, if you want more information, my email's on the next slide, and there's more information on the Criterion website as well. So thank you very much, and back to you, Siva.
Thank you, Susie, for that wonderful presentation. Gender lens investing and how one frames it is indeed important for Sri Lanka and the wider region. Up next, I would like to welcome Ms. Mei Lin Yip, Manager for Asia Pacific, rather, at the Convergence Finance, to present on what is blended finance, the structures that are working across the region, and what would work in Sri Lanka. Ms. Yip, over to
Yeah, thank you, Siva. I'm excited to be here today with all of you. Thank you for inviting Convergence today, and honored to be speaking alongside Criterion. My name is May. I'm the manager for the APAC region of Convergence, and I'm based in Singapore. So what I'm going to do with my presentation, I will take you through blended finance 101, so that later on we're on the same page on what is blended finance before we dive deeper into our fireside chat later on. Okay, next slide, please. Okay, first I give a quick introduction to Convergence first for those who are not familiar with Convergence. So who are we? We are headquartered in Canada, and we exist to increase private investment in emerging markets and developing economies to advance the United Nations Sustainable Development Goals and Paris Agreement. We do this through 4 different pathways here. The first one is Guide. We have the largest depository of data of blended finance. So think of us like the Bloomberg for blended finance. And with our rich data, we build thought leadership on publications, knowledge pieces, such as the State of Blended Finance report. And the second pillar is on Educate. So we conduct various capacity building workshops at country level. The third is we convene various stakeholders from the public, private, and philanthropic in the same room to really foster partnership. The last one, Mobilize. We give out early stage grants to design innovative blended finance structures. And one of the programs that we are running in Asia is known as Asia Climate Solutions Design Grant. We co-created this with the Central Bank of Singapore, Monetary Authority of Singapore, Department of Foreign Affairs, Trade Australia, Rockefeller Foundation, and a single family office. So all this is really in a spirit of advancing the Asian blended finance ecosystem. If we move to the next slide, please. Okay, so Convergence is a global network for blended finance, and we see our role as an ecosystem builder. So we have close to 200 members from the public, private, philanthropic sector on our network, as you can see here. So we are a non-profit, and we are sector and SDG agnostic. Next slide, please. Okay, So before we understand what is blended finance, let's set some brief context. So as you all know, there's an urgency to reach the UN Sustainable Development Goals by 2030. But currently there's a 4 trillion annual funding gap, and which public funding alone cannot fill, be it through aid money or public finances. So to bridge this gap, private sector investment must be mobilized, and this is what Convergence champions. So blended finance simply is the use of catalytic capital from either public or philanthropic sources, as you can see here, to increase private sector investment in developing economies. So the key point here is blended finance is a structuring approach that essentially allows different types of capital to invest alongside each other while achieving their own objectives. So in order to mobilize the private investments, as you can see at the top circle there, so this can involve, for example, public actors, for example, like JICA, the Japan International Cooperation Agency, participating in a transaction on concessional terms. So it can be through providing some sort of concessional investments, such as debt at a lower interest rate or equity, for instance, in a more risk-bearing position in the capital stack, or through guarantees offered at below market terms, or grants to help prove the feasibility of the transaction. So to summarize, blended finance is nothing more than how do we use this very scarce pool of non-commercial money, development funding, which is available right now in a very strategic way. So why do we have to be strategic? So that we can alter the risk-return profile of such projects investments to make them more bankable, more investable, and then attract private finance to flow in areas where currently is not flowing, and to come in at market rate return. And the purpose of blended finance is essentially to solve for market failures. Okay, moving on to the next slide. Okay, so what are the key characteristics that are important to qualify as a blended finance transaction? So there are 3. The first one is leverage. So what we are looking for here is how much of non-commercial money or development funding could mobilize or attract private sector capital to areas where currently it's not going. So our data shows that $1 of development funding is able to attract $4 of commercial money. The second one is the impact. So what we are looking for is really projects or investments which are trying to move any of the 17 SDGs forward. And the third one is return. So as you've seen from the earlier diagram earlier on, it is clear that there are different stakeholders who are coming together with different return objectives. So the private sector will be coming in at market rate return, and then you have the development funders who are ready to take lesser return or sometimes no returns at all, with the sole objective of really advancing the sustainable development goals. So in summary, blended finance transaction sits right at this intersection of leverage, impact, and return. We move on to the next slide. Now let's deep dive a little bit on leverage. So what we've seen, as I mentioned earlier from our database, is on average, $1 of development funding or $1 of concessional funding is able to mobilize around $4 of commercial money. And so that's the leverage that we're talking about today. So if you take a step back, right? If you are following the state of development funding that is coming from various concessional sources today, you'll be aware that currently is only sitting at 220 billion annually. And is this pot growing? Unfortunately, it is in fact shrinking and it's not growing, especially more so with the current geopolitical landscape. And so now the question is to plug this SDG financing gap. How do we bridge this financing gap, which is in trillions? And on the other hand, you have a development funding which is of 220 billion. So in other words, how do you solve for trillion problems with a billions funding, right? So the funding needs is actually 18 times greater than existing overseas development assistance volume. So the only way to bridge this gap is really to bring in the private sector in, and blended finance is one such mechanism which try to do that via de-risking. So an example, so that we can mobilize the mainstream capital to join hands with the development funding to achieve the collective sustainable development goals. So in short, if we want to bridge this financing gap in trillions, we have to bring the private sector along. Next slide, please. Okay, what you see here on this graph is the dark blue line is the market efficient risk return line. Now, all the projects which are on the line or above, great, because they are completely bankable, investable. And the projects which are below that line is something which is unfortunately not bankable and investable. And most of the projects in emerging markets tend to lie below this line. So what you are trying to do through a blended finance structure is, for example, if you have a project at that position, if you see the A, you are either trying to de-risk it by moving that project from A to B through a blended finance instrument, or you are trying to enhance returns, which is moving from position A to C, so that you can now have commercial investors who have fiduciary responsibility, for example, like pension funds, can now invest from a fiduciary capacity. Next slide, please. Okay, now this slide essentially is trying to reflect the different forms of funding as we know in the market today. So I'm sure many of us are familiar with aid and philanthropy. What it tries to do is achieve these development objectives, and the typical key actors in this space are aid agency and donor agency, not-profits, etc. And the second bucket, you have the impact and social investor who are really focusing on creating impact, but also trying to generate financial return, which is close to market return. And the third one, you have the commercial investor, of course, while looking purely for commercial deals and transaction. So what we are trying to say in this slide is, rather than these various pot of capital operating in isolation, blended finance try to bring the aid, the impact investing, and the commercial investment all into one structure. And that one structure can be structured as a fund, a facility, a bond, or a note, which then help us to achieve what we are set to achieve, because till these different parts of capital work in isolation, it is very unlikely that we'll be able to achieve this SDG financing gap. So that's why we have to be very strategic about our capital. And the best thing about blended finance is it is not an investing approach. It's a structuring approach. So it's a blended finance is not impact investing, but impact investing deals can be blended, but not all are blended. So you can structure it in the way that works for you. So, and that is why we want this different forms of actors to come together in the same structure rather than them operating in silo. If we move on to the next slide. Okay, now that we understand why is it important, the importance of blended finance, so how do we apply it? So these are the 4 common blended finance archetypes. So the first one right on the left, it describes how the different concessional components of transaction are mobilizing private investment and what are different ways that you can apply concessionary to a transaction. So if you can look at the graph one, the first one, being concessional debt and equity. So this is when, for example, a public or philanthropic investor will participate in the capital structure. So it's either providing debt or equity on below market terms, or where they are taking on a higher risk-bearing position in a transaction. Yeah. So, for example, it could be like providing debt at a lower interest rate, or they can take on a disproportionate risk and lower return in equity. So by doing that, they are mobilizing the commercial investor to come in at senior position. The next one, the next archetype is through guarantees and insurance. So these are what we call risk reduction tools. This is where, for example, a guarantee will be provided at below market rates, for example, like a credit guarantee. And then they will offer a below market rate to cover, for example, like default and various type of risk. And the third one, if you can see, that one is design and preparation stage grant. So this coming at the early part of a transaction. So these kind of grants typically are used to fund feasibility studies, proof of concept, or to conduct pilots and to prove business models. And eventually the purpose is to improve investors' confidence. And the last one is technical assistance. Technical assistance can be used during pre-investment or post-investment stage. The purpose is really to support better project implementation to help increase the capacity of the project sponsor. So in summary, these are the 4 archetypes And I'll bring you on to the next slide. Okay, so as I mentioned, as I shared the four archetypes, right? Just take note that a blended finance structure may have one of these archetypes in a transaction. So not necessarily just one archetype. Okay, so this is basically, okay, after sharing the four archetypes, so how do we apply it? So imagine this is a deal cycle, right? So for example, project finance deal, for instance. So if you can see in the preparation phase of a deal, at the early onset, grants or technical assistance could be used to help conduct project preparation and prove feasibility of the projects, like I mentioned before. And the next stage is the formation stage. So for example, early stage equity investment with significant first loss capital could be used. And after that, you move along in the construction phase. Here, you could potentially have a blended commercial debt or equity investment with a concessional first loss facility. So if you can see here, the concessionality will taper off over a period of time. So the idea of blended finance is that you provide more support at early stages by taking on initial risks to help to bridge the financing gap, but it will fade away as it becomes more and more commercially viable. Moving on to the next slide. Okay, so once again to highlight, blended finance may be very promising, but we want to stress that it is not a silver bullet for everything. Because if something needs concessionality forever, we need to think again. Because blended finance may not be the answer. So it's very crucial to know when to use blended finance and when not to use blended finance, because it simply cannot be applied to everything. So what I'm trying to highlight here is that, number one, you are looking at an application where you make something which is not commercially viable today to something which gets commercially viable over a period of time. Next slide, please. Okay, this is my last slide. So I'd like to summarize. Some key takeaways for the audience here today on how we see blended finance as a transition tool. So when we say transition, we are trying to highlight that you are looking at an application where you move something which is not commercially viable to something that gets commercially viable over a period of time. And to us, that is the best application of a blended finance transaction. So if you look at this, you know the four key takeaways. The first one, clearly, blended finance supports more bankable and investable projects. Second, it helps to reduce and lower the cost of capital for projects. And the third, it clearly mitigates risk and enhance returns for projects, as we have seen from the graph earlier on. And the last one, which is most importantly, it brings the public, private, and philanthropic partnerships to come together to advance the sustainable development goals and financing towards those areas. Next slide, please. Yeah, so with this, I end my presentation. Happy to take on any questions you have later on. So I'd like to pass back the time to Ziva. Thank you.
Thank you, Ms. Yip, for that insightful presentation. Next, I would like to welcome again both Ms. Pan and Ms. Yip for a brief panel discussion to explore further on how the two focus areas for today have worked together in the past and what Sri Lanka can learn from these examples. And while we start the discussion, I would also like to highlight that we will be taking audience questions as well. So please feel free to post your questions through the Q&A option. Maybe we can start off the discussion with the first question I had in mind when the both of you were presenting, Ms. Pan and Ms. Yip. So across both gender lens investing and then also blended finance, the concept of blended finance, we are seeing a shift from these being niche or pilot approaches towards more integrated mainstream investment practices. So from your own perspectives, what are the most significant global and South Asian trends you're seeing in how these approaches are being designed, deployed, or positioned, with investors? And then what should Sri Lanka be paying close attention, as we begin to shape the country's own path? Maybe I'll let Ms. Pan come in first, and then maybe Ms. Yip can follow.
Sure, thank you. So one of the pieces I mentioned earlier, and I think that we see a lot more, is general lens investing has been around for maybe 20 years. So it's still relatively new in the impact investing world. But part of what it started as is investing in women. So I think we're seeing more movement away from just investing in women to understanding gender patterns and analysis, thinking about the sectors and the industry we invest in. And I think this approach, we actually recently wrote a paper about this, about the future of genderless investing, is not one approach. So I think one of the trends we're seeing is that genderless investing is become more diverse. It's becoming more intersectional. So gender, woman is not an issue by itself, but it's how in climate you think about women, in education you think about women, in healthcare how you think about women. It's also becoming more regionally focused. One of the histories of gender lens investing is that it started actually with Gender Smart and 2X as defining some global standards for what gender lens investing is. But I would say in a recent few years, and especially in the recent last year or two, given the political context and the spend of US aid, there's a lot more regional mobilization and local mobilization of what that looks like. So this is why I would say implementation and context really matters. So instead of having a global centric view, and this is, I think, the opportunity for Sri Lanka, is to really look at locally what does it mean for the context and really start from the local design of what is it that you need in the context that you have, and becoming much more driven from a local perspective. And then the last thing I'll say is, given some of the global context of today's world, a lot of people are doing gender lens investing without calling it that. So I think there's a lot of different impact investors, DFIs, or just general investors who are looking at gender patterns, who are looking at the data they have in gender, but don't always call that gender lens investing. So really understanding that it's moving away from just DEI and compliance and doing this deeper analysis that's very locally context and nuanced and not one size fits all. So I'll pass it over to May and Convergence.
Sorry, on mute. Yeah. Thanks, Susie, and thanks, Siva, for the question. Okay, sure. First, I will start off with what we are seeing for the trends in blended finance globally, and then we deep dive into Asia and also like what does that mean for Sri Lanka as well. So what we are seeing globally for blended finance. So Convergence to date has recorded over 463 blended finance transactions globally that target the SDG 5, which is gender equality. So just to set a context, right? To date, we have recorded more than 1,500 deals at 260 billion of financing. So out of this 1,500, 460 are targeting gender equality. So that's nearly a quarter of all blended finance volume. And now narrowing that into the Asia region, Asia accounts for 25% of global gender-related blended finance deals, standing at 115 deals. And out of this 20%, right, South Asia alone contributes more than 64%, valued at USD 15 billion. So now, where does Sri Lanka stand in this picture? So to date, based on Convergence market data, Sri Lanka has recorded 18 blended finance deals totaling around USD 3 billion. So out of those 18 transactions, 4 out of 10 directly targets SDG 5, which is on gender equality. So we also noticed that this gender-focused deals um, uh, is accounted for around 1.3 billion in financing, and gender equality is actually the top 4 SDG targeted in Sri Lanka, alongside health services, no poverty, and reduced inequality. And where are these deals concentrated in? They are concentrated in financial services, health, and agriculture. So this is a bit different from the global trends, because global trends, we see that most of blended finance transaction tends to go into like energy, infrastructure, and financial services. So coming back to Sri Lanka, they are focusing more on subsectors like microfinance, retail banking, and health services. And they typically use fund structure, and the most common blending archetype is concessional capital. And roughly 60% of the direct beneficiaries are reached through microfinance institution, with another 20% through MSME. So together, this form the backbone of Sri Lanka inclusive finance landscape. So why is this the case is because we notice that financial institutions are the fastest and most scalable channel to reach women, rural clients, and small businesses. They are also trusted partners for development finance institution because they are able to absorb larger investment and to manage risk as well. So what does that mean for Sri Lanka, right? So based on the global and regional trends that I've mentioned, three areas that are particularly we feel that is relevant for Sri Lanka to shape the path forward. First is to support first-time deal sponsor by integrating gender lens early. So one of the biggest takeaway from one of global analysis is that gender integration needs to happen early at the design stage, not as an afterthought. Because many first-time deal sponsor face challenges, for example, like they lack gender disaggregated baseline data, impact measurements, and the technical know-how. So this is when design stage grants and acceleration support are very, very important. And that's where concessional capital provider can offer technical assistance, gender diagnosis, and KPI development funding to really help this deal sponsor to build strong gender integrated investment vehicle. So, and this is very important because there are certain sectors where gender linkage is not so obvious, like for example, like climate, infrastructure, and agriculture.
Thank you, Ms. Heap. So maybe building on that. So if Sri Lanka were to design its own locally grounded approach to genderless investing, and also bringing in blended finance, rather than importing, venture or donor-led models, what principles should guide that design? Where do you see the biggest ecosystem gaps today, and how can collaboration across investors, intermediaries, and civil society help bridge this? Maybe let Ms. Yeep come in first, and then Ms. Pan can, add from an ecosystem.
Yeah, thanks, Siva. It's a great question. And I think it's really timely as for Sri Lanka as we think about how we shape our Sri Lanka identity in gender lens investing and blended finance rather than simply borrowing from like donor-led or global north models. So I would say that to design a globally grounded approach, I would like to offer three like guiding principles. The first one is really about mainstream gender into investment analysis. I believe Susie has said this right, and right from the start. So the first principle is about embedding gender analysis into how capital decisions are made. As Susie mentioned about the 2X, we have seen momentum on this globally on this front. So in 2024, we've seen the release of the updated, the 2X, the criteria reference guide, and also the launch of 2X certification. So these two are really powerful tools to mainstream gender across all types of financial institutions, from DFI to private equity to local banks. And the good news is these two are not just limited to like high-end investors, so they can be adaptable. And then there's an opportunity for Sri Lanka to build local capacity on how to contextualize and apply them consistently so that it's easier for investors in this space to screen, measure, and communicate gender impact across this growing ecosystem. The second principle is really on moving beyond counting hits, right? But really to build robust gender assessment and frameworks. So in the past, genderland investing focused on like basically like disaggregated data, for example, how many women were reached or how many women owned businesses were supported. That's still important, but in today's context, it's still not enough. We still need to assess, for example, the gender inclusivity of investment decision making, diversity of leadership teams, and how funds and vehicles are actually shifting power dynamics and not just outcomes, like what Susie mentioned. So I'd like to offer an example on this. So a great example for this shift is the recent this toolkit for gender lens investing released by IP Global. So this is really based on learnings from the USAID-backed Summit Blended Finance Facility. So yeah, so that toolkit shows that how even at fund level, teams can apply gender equity from an equal gender investment committee to gender sensitization during selection process. So perhaps there's some synergy or alignment that Sri Lanka can adopt here, localize some of these tools or tailoring assessment frameworks For example, sectors like healthcare, MSME, and financial inclusion, which we believe have really strong gender touch points. The third guiding principle is really how do we focus on long-term gender outcomes, not just 3-year inputs. So this is really on patience and really to design it for systemic change. So what we see in blended finance is a lot of it are driven by short-term funding cycle. So what happens is deals often prioritize outputs like job creation over deeper outcomes, like for example, improve livelihood or shift in gender or decision-making power, like what Susie said, right? It's not just access, but access to what? So I guess if you want to build this like approach, locally rooted approach in Sri Lanka, we need long-term capital structure and blended finance vehicle with multi-phase or adaptive funding that allow this gender strategy to evolve and deliver transformation result over time rather than just a 3-year output. And now moving on to the next part of the question is what is the biggest ecosystem gap? So in one word, we would say that it's catalytic capital. So if you read our recent State of Blended Finance report, public and philanthropic actors supply over 60% of concessional capital. And we have not seen impact investors stepping up to play a catalytic role yet. So for the past 3 years, we've seen that impact investors are represented only 6%. And for this 6%, that are participating in a blended finance transaction, most of them are participating at a commercial senior position, not the concessional and junior layer that actually de-risk deals and attract other investors in. So currently, with the impact investor resemble more closely to traditional commercial investors. So sometimes they also require, like for example, other DFIs or MDB to take on the risk capital or more junior position so that it's safe for them to participate. So now we believe that impact investors have a catalytic edge because they can be flexible, take on more risk, structure. It can be structured for mobilization and additionality, not just like stable returns. So perhaps there's something to explore there. So quoting example again, in our data, we've seen impact investors like Asenia, Carvet, Impact Capital, and Blue Orchard. They are showing us how it's done by going at junior equity, subordinated debt, and first loss capital. But these are global names. We have yet to see like a regional representation or maybe like perhaps there's an opportunity for like a Sri Lanka-based representation as well. Yeah, I will just hand over the time to Susie to add on.
Yeah, thanks, Ailey. I think you cover a lot of the pieces on the how, so maybe I'll name some of the mindset pieces
Sure.
that's necessary because I think one of the first things that I said to begin the conversation is to be able to have an imagination that it's possible and that it could be different. I think part of the challenge is to say to design a model from scratch means needing to imagine it versus to copy someone else and copy what's already been done in other countries or copy what's been done as the global North success model or Silicon Valley or things like that. So really be able to have a financial imagination. So we coined this term around the ability to have a financial imagination to imagine different ways finance can be used. The second piece, I think, is actually really around collaboration. I think, as you mentioned, collaboration not just between different players, but between different parts of the ecosystem. I think one of the pieces when I was in Sri Lanka, was that everyone's doing really great work, but not always talking to everyone else and very insularly. So there are a certain set of entrepreneurs or a certain set of investors, and you all know each other, but you might not know the other people around it that are different types of entrepreneurs or different type of investors. So this is also between public sector, governments, entrepreneurs, and actually the biggest piece is actually about women rights organizations. One of the things people will say about genderless investing is that you can't be a biotech investor without you understand biotechnology. You can't be a climate investor without understanding climate. You should not be a genderless investor if you don't understand gender. And the people who have the gender expertise are actually the women rights organization on the ground and are the people with the lived experience. So being able to incorporate them as actors in gender lens investing is really important. So a lot of the work we're doing through GRIT and through the program we're doing with LIIS is building what we call a translation function between gender and finance. So really valuing the expertise of a women's rights organization to understand they understand gender from a technical perspective and then applying it to finance is a really big part. And then maybe the last thing I'll say is just I think it's a mindset of having how do we fix the capital and not the company. Very often it's like who are the entrepreneurs, who are the end benefactors that we want to impact, and how do we bring them into the design and actually build what they need versus always starting with, like I said, the capital. And this to me is more of a mindset shift than it is a technical shift. There are lots of like blended finance structures allowed to do that. But if you don't start with a different starting place, it's hard to get to that innovation. So really understanding that a financial imagination, collaboration in all different ways and expertise, and then having a different mindset of how we approach finance.
Great. Thank you, Ms. Pan. Maybe my concluding question, just to build on the discussion, and this is for the both of you, would be looking forward, what changes, whether in capital structures, asset classes, regulation, or leadership, are most critical to scaling gender smart blended finance approaches in markets like Sri Lanka? And what role can convenings like this and what we're having in February, as well as senior leaders who would be, attending these events, play in providing credibility, flexibility, and sort of an air cover needed for this, field to mature? Maybe I'd like Ms. Pan to come in, and then maybe Ms. Yip to follow it.
Yeah, I'll just keep it short to say, I think I touched a little bit about this in the last answer, but maybe one of the pieces is how do you lend your power as a leader to the people who need it? So if you're able to give credibility to the rural entrepreneur or the rural woman as an entrepreneur, that is something you will be able to do as an investor, as a government official, as a banker. The other piece I didn't touch a ton about, but it's actually really important for both blended finance and different structures, regulations. It's one of the ways that it's being slowed down. And it's one of the main blockers for people to innovate is around regulations that allow for innovation and allow for different structures. I'll pass it to me.
Yeah, thanks, Susie. Yeah, so looking ahead, a few shifts really stand out to us if we want to scale like gender lens investing and blended finance in markets like Sri Lanka. So this really came through when we were writing our South Asia data brief and we interview a few practitioners across the region. So the first one is really on the capital structure, especially the single biggest pain point we heard is especially currency risk. Because most blended finance still comes in hard currency, while local businesses, particularly like SMEs or women-led enterprises, are earning in local currency. So that mismatch really creates like vulnerability because if you want to scale these structures, we need more local currency solutions, whether be it that through guarantee or concessional capital that can absorb foreign exchange risk or better hedging mechanism. So without that, a lot of good projects simply won't be viable. So that's the first one on currency risk. The second one that came really out a lot through our conversation is the policy and regulatory environment, which what Susie mentioned earlier on. So what we observe is many countries are still operating with frameworks that were not designed for innovative financing models like blended finance. So from an investor's perspective, that lack of clarity or consistency is a real market deterrent. So for now, there's only two guidance in the space of blended finance. The first one is it comes from the OECD principles, but that's more from a developed market lens. The second one is from the MDBs and DFI lens, but that's more from their investing point of view, right? So what's missing is really like a practical region-specific guidance for emerging markets in Asia. So that's why this gap is exactly why Convergence has been working with UNDP. We are working on this work called Framework for Blended Finance for Emerging Markets. It's really to help regulators and policymakers create an enabling environment that actually de-risk investment, crowding private capital in Asia. So we'll be launching this piece of work in Asia during Philippines ASEAN chairmanship. So for those of you who are interested, can look out for that piece of work. And the third one is really like, where is the capital going, right? So blended finance in South Asia are still very climate heavy. They are going into like things like energy storage, microgrids, cooling, and biofuels. Those investments, of course, are critical, but at the same time, social sectors are underinvested, like for example, like health and education. And we feel that where this gender impact can be incredibly high, and this gap came through clearly in our data. So very few blended finance transactions in this region are actually targeting these areas, even though they are really core to inclusive development. So to really move the needle, we need to see more catalytic capital coming upfront, build up also the investment ecosystem, and give investors the confidence to really go into these less familiar sectors. But one bright spot is we started to see some movement towards we call it cross-sectoral gender lens strategies. For example, these are financial vehicles that don't focus on just one area, but look across, for example, like agriculture, education, and health together. So this approach actually makes sense because women and girls, they don't live their life in silos. So their needs and the opportunity to support them actually cut across multiple sectors. So financial structure should also reflect that as well. And when we talk about scaling like blended finance to really benefit, like just say women and girls, there's a few key areas that we feel that is important to get right as gender lens investing start to gain traction in the region. First is really on the strategy. We need high level intentional approaches to gender mainstreaming. So basically strategies that link gender to national priorities and key sectors rather than taking it as an add-on or a side goal. So that also means it must be measurable and it must be clear for tracking, because without matrix and accountability, gender outcomes may not be prioritized. The second is really on stronger buy-in, not just from partners, but also from investees. So gender lens investing to frame, Susie went through the framing just now. One is market opportunity, not just like a moral imperative. So basically, like, how do we engage? What entry points do we use? How do we communicate value? And how do we align incentives? So not just structure, but the right language can also make a big difference into mobilizing private sector into gender lens blended finance structure. And the last one is because we've seen a lot of technical assistant use in blended finance. We see that technical assistant can be used in two ways, right? One is not just one at a fund level, one is at a project level. So project level is really to build capacity for the investees. But at a fund level, it's really important to use it to support broader ecosystem development, like address systemic issues, pipeline creation, and data and policy reform. Yeah. So, and I just like to end on that's why we feel that platform like Lean really play a critical role, because we believe that civil organization, number one, can act as local anchors because they are closer to the ground, they understand the local landscape. So they are in a good position to help businesses, especially those led by women, to become investment ready. So that's really important if we want the capital to move beyond just like large-scale infrastructure project, but into sectors, into social sectors or communities that are often overlooked. And the second one is the second biggest challenge of blended finance is we often hear that they are very small, very fragmented, very hard to scale. So it's not so attractive to large institutions. So that's where we feel local actors coming in is very important. Like for example, the role of an intermediary to play the aggregation role so that you can aggregate all these smaller deals together to address multiple priorities, not just gender, but also climate and health, but while still deliver the local impacts. So yeah, working with trusted local intermediaries is really important if you want to reach this like women underserved group. And the last one is really is food for thought on how impact investor can rediscover or lean back into their catalytic age. Because so far, a lot of capital in blended finance still comes in commercial terms. What we need is also more players willing to take that first loss or anchor position, especially at the early onset, right? So that other people can follow on. As I mentioned, we've seen global example covered Sydney, Blue Orchard, but perhaps there's a Sri Lanka version of that leadership. So, and we also feel that that's where also Lean can play a role by building local capacity, sending a strong market signal that Sri Lanka is ready for gender smart blended investment. So I think the call to action here is not just having the capital, but being bold enough to lead in this space. Yeah. Thank you.
Thank you. Thank you, Ms. Yip. And with that, we've come to the end of today's webinar. I would like to thank Ms. Pan and Ms. Yip for dedicating your time and effort to contribute to this webinar. We hope to work together more, as you mentioned, to create meaningful change in Sri Lanka and the wider region. We will continue this conversation into February as well, with the two events we highlighted when we started the program. The Impact Investment Executive Immersion program, focusing on key concepts of impact investing, and also provides you with an internationally recognized certification. The program will take place on the 9th and 10th of February at the Shangri-La Colombo. You can scan the QR code or click on the link on the chat to register. And that will be followed by the flagship event, the Lanka Impact Investment Summit 2026, which will bring together key international impact investors, development partners, and also leading corporates and SMEs and other stakeholders for a two-day convening. The summit will take place on the 10th and 11th of February at the Shangri-La Colombo. Please scan the QR code or click on the link on the chat to register. And if you would like to get more information about both the events, please reach out to the email address provided on the chat. And once again, we thank all the participants who joined us today. We hope to meet every one of you at the events in February. Thank you and have a great day.